Hi, everyone. My name is Sudipto Banerjee, and I'm with Tiro Prize, and I'll be your moderator for this session. So we are almost at the end of this year's PRC Symposium, but we have one final event left, as Olivia mentioned, the closing keynote. And for that, we are going back to the world of pensions. I recently saw a report by Morningstar, which came out maybe just about a month ago, and it said that DB plans still accounted for more than 30% of all distributions paid to plan participants in 2019, and they haven't peaked yet. So as much as we think that pensions are a thing of the past, they're not really going away anywhere anytime soon. So in today's keynote, we will learn about the challenges and the path forward for today's pension systems. And it is my pleasure to introduce David Knox, who will take us through this over the next half hour or so. David is a senior partner at Mercer and senior actuary for Australia. He is the national leader for research and policy and has been the actuary to several public sector pension plans. He is the lead author of the Mercer CFA Institute Global Pension Index, now in its 13th year. Before joining Mercer, David was at PricewaterhouseCoopers, and prior to that, he was a foundation professor of actuarial studies at the University of Melbourne. He has acted as a consultant to a range of financial organizations and in both the private and public sectors, specializing in superannuation and retirement income areas. He has spoken and written widely in this area and served on many government and industry committees. So it is quite an understatement to say that David is a pension expert, and we are truly delighted to have him with us today. With that out of the way, and without further ado, please welcome David Knox.
Thank you very much, and welcome from Australia. I would love to be with you, but we live in different times, and this will be a virtual presentation. So let me share my screen and let's get underway. What I'm going to look at today is what have we learnt about the objectives and the resilience of pension systems, particularly in the COVID last couple of years. But the lessons we will learn are not just what we've learned in the last year or two, but in fact, they have longer term implications. So let's have a look at today's agenda. I've broken it down into three broad areas because I think as we look at the lessons from COVID, we need to think about the objectives and purposes of our systems. We need to look at the resilience of pension schemes, pension plans in the US and elsewhere in the world. And I will make some conclusions about the future and how we can move forward. And then I'll look forward to having a discussion with Sudipto and questions from him as we explore some other topics. So as we look at the learnings, I think it's important to go back a step and say, what are the objectives of our retirement systems? And here I'm not just looking at a single pension plan, but the broader system. And in my view, there are two broad objectives. One is to alleviate poverty amongst the old, to make sure that in a civilized society, they have a reasonable standard of living and live with some dignity. Secondly, I want to suggest that we want to enable most people when they reach retirement to maintain their, what I'm calling their previous standard of living. Now, here I'm not talking about the well-paid sporting stars or the flamboyant movie stars, but I'm talking about most people. And we want to ensure that they can continue, broadly speaking, the standard of living that they've had in the last 10 or 20 years. Let's not go back to when they were students at the age of 20 or 22. I don't want to go back to my standard of living at that level, but let's have a look at the last 10 or 20 years. To do that, I think we need at least two systems. One is a government or public pension that supports the poor and may well provide some support to everybody. as well as providing the second system is a funded pension arrangement that enables you to spread your income from your working years through to include your retirement years. So what are some of the lessons that we've got here? Well, I think the first lesson is that if we have more than one pillar in a system, a multi-pillar system, including public and private pensions, then we broaden the opportunities and reduce the risks. Secondly, and this is where COVID comes in, when we look at these objectives, they must have a long-term focus. It's not just next year or even the next 5 years. We are talking about decades. And thirdly, I think clear objectives of a system help the alignment of all stakeholders, whether they're the pension providers, whether they're government, politicians, policymakers, the media, etc. It amazes me that very, very few countries, very few pension systems have clear objectives. So this means that when a crisis arises, everyone is talking or attacking it, if you like, from different angles. We don't know where we want to go because we've never agreed to the direction and the objectives when things were a little bit calmer. So I'm a big supporter of clear objectives. Okay, so let's have a look at some of the lessons we've learned. Firstly, I'm looking at our global pension index and looking at it from the change in the first year of the pandemic. From 2020 to 2021, we'll do this again later this year in 2022, but of course we haven't got the results. But even in the first year of the pandemic, there were some really interesting changes. Firstly, in many economies, household savings increased. People, on average, people didn't travel. They didn't go out to the restaurants. They didn't go to entertainment. So in fact, savings increased, and they increased significantly in a number of Anglo-Saxon countries, including my own country of Australia. We now have a lot of households with savings tucked away, not in the pension system. Now, some of that savings may be used as people start to travel, but some of it will in fact find its way into retirement. Secondly, as we know, government debt in many countries increased significantly. On average, across the 39 systems by more than 4% of GDP, and in fact in India, Hong Kong and Norway by more than 10% of GDP in 1 year, a significant increase. But thirdly, we also saw that pension assets as a proportion of GDP increased. And so there's more money that has been put aside for the future. And if you look at some of the Willis Towers Watson numbers, over the last 10 or 20 years, pension systems around the world on average have earned a nominal rate of 6.8%. And in period of low inflation, that's a very good real return. So we are seeing pension assets rise when expressed as a percentage of the economy. Now, as we look to the future, I just want to briefly mention some global trends. We've already had the mention of the defined benefit and defined contribution. Clearly around the world, we are seeing a gradual shift from DB to DC. Inflation is also back, higher in some countries than others, but it's back. Interest rates are rising again around the world, and I think we'll continue to see that. So with these very broad global trends, the world is changing. The pension systems are not what they were 10 or 20 years ago. And therefore, we need to think beyond our traditional paradigms. Now let's have a look at some of the lessons we learned from COVID. In some countries, we had government saying, okay, let's release some assets. Let's release some of the pension assets to those who need it, or to anybody, depending on the rules that were set up. Well, clearly such events helped offset the immediate economic impact to some individuals and households. That meant that government expenditure may be able to be reduced. On the other hand, some member accounts were absolutely wiped out. A good example in Australia, when individuals were able to take $20,000 out over a 2-year period, many younger members took the money out and they now have no pension account. They've got to start again. In the early months of COVID, they were often paid out at times of depressed markets. So people didn't actually get the full value of their accumulation. Chile was an example where about 25% of the assets were withdrawn in that very short period. So these were negatives. One of the positives was, in fact, some members now learnt which pension scheme they were a member of, because they said, hey, I want some money. The government's allowed me to have some money. Oh, I'm a member of this scheme. And all of a sudden, hey, I know my pension scheme. Well, that's a plus, but there were some negatives as well. Now, some lessons from this event. I think a funded scheme clearly offers this option. A pay-as-you-go scheme, you can't do that. But I've always been a big supporter that if we've got a pension scheme, it's about retirement. It's about smoothing that income into retirement, and therefore you've got to preserve the money. Early release of assets does away with that preservation. So you're actually using money now, which means your retirement will have less money. It reduces future benefits. So in my view, these early release of assets should really be the last resort. And in some countries, in some systems, we saw governments introduce it when, in my view, it wasn't really needed, or it would have been better for the government to support the individuals or households rather than the pension system, at least in the early months. One of the other consequences of COVID-19 is that I think we are seeing greater inequality. The impact of COVID-19 has not been spread universally across all communities, across different socioeconomic groups. So we've seen greater impact in some industries, such as hospitality, such as tourism. We've seen greater impact on low-income earners. In some workers have been unable to work at home. If you're working in an abattoir, you can't do that work at home. It's had a greater impact on women more than men. So I think what we've seen is that there's been a broadening of the pension inequalities, and therefore the pension gaps have widened. What are some lessons here? Well, I think during a crisis such as COVID-19, where the government may be supporting individuals and households with financial support, it would be better if that financial support included some pension credit or some pension contributions. And we saw that in the Netherlands and the UK, for example. I think we need to think about how we develop measures to reduce the gender pension gap. We know it exists. COVID-19 has added to it, in my view, or broadened it. And there are a number of measures we could take, but one of the things I'm attracted to is the concept of if you like, a pension baby bonus after the birth of a child paid to primary carers for at least a year or two. And then I think what it's highlighted also is that in a pension system, we need to make sure that the pillars work together. How does a public pension system and the private pension work together and complement each other? They are not independent. And I think COVID-19 has highlighted that in some systems that integration is not as good as it could be. So then the question comes, in post-COVID world, and indeed as inflation starts to rise again, can pension outcomes be maintained? Well, in terms of COVID, what have we seen? Reduced pension contributions. Employment has been cut or reduced. In some cases, companies, employer sponsors have reduced their support. We've had reduced workforce opportunities. There were reduced investment returns for a period. Some of the markets bounced back, but let's wait and see. And interestingly, from a societal point of view, I think it's been highlighted that people are now much more interested in work-life balance. And can I work at home? That's been a real advantage. I can take the kids to school, etc. So how does that play out? And how does that play out in terms of my employment and my pension contributions? So as we move into the post-COVID world, and there will be some individuals who now have less pension assets, what are they going to do about this? Will they say, actually, I've earned 6 or 7% the last few years, now I'm not earning that, I've got less, am I going to take on more investment risk? May not be a good idea, but they will ask that question. Will I work a little bit longer to overcome the shortfall? Will I lower my expectations on what I can afford to do in retirement? Or in fact, will I put more money into my pension scheme and review my contributions? So you can see there's a range of options that individuals may consider in the post-COVID world. Now, another thing that's happened in COVID, of course, is mortality rates have been affected. Now, this is still a little bit speculative because we are living in a period where clearly some people have died from COVID, but other people have what we call long COVID. They have had longer term impacts of COVID. They haven't recovered quickly. And we're not quite sure what the long-term impacts of some of that will be. Nevertheless, we've seen increased mortality in some age groups and in some cohorts in some socioeconomic groups. As far as I've been able to gather, most defined benefit funds that pay pensions have had less impact, predominantly because they've got a white collar bias, and most of the impact has been at the lower income economic group. But as I said, the long-term impacts remain a little bit unclear. But there are some lessons here. Life expectancy gap, I think, between socioeconomic groups is likely to widen. We know there's always been a gap between the upper socioeconomic group and the lower group. I think that is likely to widen. And I think that has consequences for how we think about designing our pension system. When people move into retirement, do we put them all in the same mortality pool or longevity pool, or do we tweak it a little bit? How do we pool the longevity risks? Or do they all come in the same pool, which will inevitably mean on average there is a bias or a favoritism to the higher socioeconomic group? That's a societal question I think we need to think about. The implications will be different for different groups in different countries, in different systems. Okay, now let's have a look at another implication of COVID-19, investment choice by individual members. It's pretty common in many defined contribution arrangements to enable individuals to switch portfolios. They have choice, and it seems to be a good thing. However, when there is a market downturn or increased uncertainty, as happened in early 2020, some individuals fly to safety. They are concerned. They say, I'm getting out of the share market, I'm moving into cash. We also, I'll show you an example in a moment, where older members are more likely to switch, and it's possibly too late anyway. And of course, many don't switch back, and they stay in their conservative or cash investment. So what are some lessons here? Long-term perspective is key. There will be volatility in the markets. There will be volatility in the economy, in a pandemic or whatever. We need to highlight that you're in a pension system for years and decades, not just weeks or months. We need to provide information, guidance, and advice. So I want to raise the question, is member choice and great freedom always a good idea? Let me give you an example from Australia. Aware Super is a major Australian superannuation or pension plan. It's got assets of $130 billion in Aussie dollars. That's about 100 billion US, give or take. More than 1 million members based in New South Wales, and it's predominantly all grown out of the public sector in both New South Wales and now Victoria. Now, when we look at what happened in the first couple of months of COVID in 2020, 2.7% of members switched investments. 79% of those who switched went into defensive alternatives. And of course, almost half, as you can see there, went into cash. When you look at the members over 55, the older members, this was a study Aware Super did, they looked at those with and without an advisor. 7.7% of those over 55 switched if they didn't have an advisor. If they had a financial advisor, only 1.8% switched. So there we see, I believe, the benefits of an advisor to highlight the long term. If you look at where did the money go, of those who switched, most of it went into defensive and half of it went into cash. And we saw that of those over 55 without an advisor, 11% of their funds under management switched. So it was a significant movement. A little note on the right-hand side, by August 2020, 2/3 who had switched to cash were still in cash. In other words, they'd stay there. The markets had rebounded and the members had actually taken money out virtually when the market had dropped, and market rebounded and they hadn't bounced back. So I think that there's a lesson here for defined contribution plans to really help members understand what is going on and focus on the long term. You will always get members who are concerned about market movements. They watch the news or read the websites every night and the share markets drop 2% or 5%. But we need to understand and need to encourage them to see pensions long-term investments. So what level of individual responsibility is best? As we know, the defined benefit pension schemes have corporate sponsors. With DC schemes, individual responsibility, and individuals bear the risks. So in this world, with changing labour markets, increased government debt, and so forth, we need to think about how much responsibility we give to the individual. What is appropriate? And do we put some warnings in place? Do we put some hurdles in place to limit the amount of switching they can do? So the lessons here, in my view, there is a need to protect consumers with appropriate defaults. Now, that's not to do away with choice, but I think we need to think about good defaults and to make sure that everyone understands they're in it for the long term. Now, we're not going to get 100% understanding. I'm a little bit of a realist, even if I'm an optimist. We need to encourage pension coverage, and of course that varies around the world, but I think we want to make sure that people are putting some money aside for the future. We need to think about the balance between individual responsibility and risk pooling, and in doing this we need to broaden our discussion to not just the private pension plan, but to look at the relevance and importance of the public pension plan, social security, if you like, so the individuals can see the total picture. And what that may mean is we need to think about different cohorts. Low-income earners, social security is more important. High-income earners, private pensions are more important. So there might be different messages, different communication for different groups or of workers and employees. Okay, so let's now look at some of the lessons relating to the resilience of pension schemes themselves. Well, firstly, what do we mean by resilience? Dictionary definition, it's the capacity to recover quickly from difficulties. Now, that I think makes sense. But in terms of pension scheme, what we're looking at is the importance of the scheme to continue to deliver on the objectives of delivering retirement incomes. Pretty simple at first sight. But what are the risks or the events that might in fact impact on this resilience? Let's have a look. Well, I think the first one is corporate failure, particularly for defined benefit schemes. In the defined benefit scheme, it may be slightly underfunded. The employer goes broke. Future and indeed perhaps unpaid employer contributions are not paid, and so any deficit may not be funded. So it's really important there that for defined benefit schemes, we think about a funding status of the scheme that's based on realistic assumptions. So we know the funding position of defined benefit schemes. But when we come to defined contribution arrangements, it's equally important that that money paid by the employer sponsor or the employer is paid on time, that they actually meet their legal obligations and pay it. We don't want a situation where an employer or corporation goes broke and they've got 6 months of unpaid contributions that may not be paid. Now, again, that will vary country by country, system by system, as to the priority of such unpaid contributions, but we've got to make sure that a corporate failure doesn't mean that the pension plan itself fails. As I note there, we may be in good times or have been in good times, but there will be risks going forward. Another risk is poor investment return. Now, we will get occasions where the investment return is poor. The share market falls, property prices fall, whatever. Is it in just the short term, or is it a longer term economic consequence? Is it just this scheme that's made some poor investments, or is in fact it's systemic wide? Is it across the board? The reason that that's important is if a pension scheme takes some rather unusual investment strategies and unusual investment decisions, and they're poor and they don't return what everybody else is doing, then the brand of that pension scheme will be affected. So we need to think about that from going forward, because if the brand of a pension scheme is affected in itself, then the trust in that pension scheme will also be affected. So we need to recognize pension schemes will have different investment strategies. I'm not saying everybody has to do the same thing, but I do recognize that there is a risk if a single pension scheme does something quite extreme and it doesn't work out, it may get isolated. Pension schemes also need to think about unforeseen events, what may happen and what their response will be. They need to communicate that to members to encourage trust and confidence in an event such as a poor investment return. Now, what happens if liquidity is stretched a little bit? We actually saw this in some systems during the pandemic. Benefits were paid out. Now, benefits may be paid out at a faster rate for a number of reasons. There may be a corporate restructure so that individuals are retrenched. The membership may gradually age. There may be a government decision encouraging benefit payments. Or in systems where individuals can move money from one scheme to another, there could be an adverse media story and members say, I want to get out of this scheme, and you get a sudden run on the pension scheme. To the extent that's possible, of course, varies system by system. Nevertheless, it's important for pension schemes to undergo stress testing. What will we do if something like this happens? Let's understand the consequences and mitigate those consequences as appropriate. So the lesson for pension schemes, broadly speaking, pension schemes are resilient, but planning is important. The unexpected does occur, And the fiduciaries, the trustees of pension schemes, need to be aware of that and ready for it. Now, one of the other risks, of course, that pension schemes operate is poor operation. There's poor service for whatever reason. It may be that some staff have left and the response rate back to members is poor. It may be an IT breakdown. It could be a number of other factors. It could be within the operations of the pension scheme, or it could be from an outsourced provider. So the lessons here are the pension scheme needs to develop a culture to learn about its operations, to learn from near misses, to learn from failures, and there needs to be constant monitoring, and the pension scheme needs to be ready to respond to changing conditions, whether they're economic, whether they're health, whether they're a government announcement, whatever it may be. So if you don't respond quickly to a poor outcome, then in this day and age, social media amongst the employees or online can actually cause a lack of trust, and people want to move out of your pension scheme. Now, the biggest risk in my view, amongst all the ones I've just mentioned, is political and regulatory intrusion. The private pension system around the world and US and Australia and elsewhere, pension systems are becoming more and more important socially and economically, and there are more and more assets there. So it's a very easy target for politicians and government to say, they've got lots of dollars, or the fees are too high, or the service is not good enough. They took a week to get back to me, or there are conflicts of interest, or there are poor returns. It's a really easy target for governments to say the pension system is not performing, it's taking your money and not delivering. You only need a few media stories, maybe an election to heighten the awareness, and a government or the opposition wanting to form government will say, we're going to tackle this. Why is this important? I think it's important because as a whole, I think the pension industry around the world has not told its story well enough. Defined benefit schemes are complex. People don't understand them. What's the purpose of our pension system? People need to be told that time and time again, and we need to say to politicians, stay away from it. Yes, we can improve it. I'm not saying they're perfect. Sometimes we do need better legislation, but the industry needs to lead and not wait to be told. The industry needs to be proactive and fix the problems either within itself or work with the governments. We need to anticipate issues, and we need to work with the regulators. We need to understand their purpose, their role, and work together to deliver better outcomes. I think we can't move away from the risk of political and regulatory action. So what's my conclusions as I sum up? I think I come back to the beginning. What's the objective of the system? The first objective is to alleviate poverty amongst the aged. I think public pensions have to continue, and they must continue to be important. But given growing government debt and given stresses in the economy, they may become a smaller proportion of the total system as we go forward. They may in fact be harder to get. And what I mean by that is there may be some means testing on some benefits. So around the world, I think we need public pensions. We need to support the poor, but should it be there for everybody? Of course, the second objective I mentioned at the outset was to maintain living standards, and therefore the private pension industry must survive and must grow. Individual schemes may not continue for a number of reasons. They may not be resilient, but in my view, the better pension schemes will be agile, They'll respond to changing circumstances. They will be accountable, transparent, and they will build trust with their members. We need to think about individuals staying with a pension scheme, not for 1 year, but indeed for decades, and being supported by them. And thirdly, there inevitably will be increased individual responsibility. Individuals will have to do it themselves more and more, but we need to guide them. We need to help them. And there are great positives for this, but as I've highlighted, there can be some negatives too. So our help and guidance to individuals retirement in their retirement years may in fact need to go beyond the pension system. Many individuals have a big asset called their home, their house. How does that work into their whole retirement system and their living standards in their later years of life? That's a question for another presentation, but I think to sum up, in terms of looking going forward, we need to think about looking after the poor, maintaining living standards, and helping individuals take on the responsibility they are going to have in future years.
Okay, thank you, David. I mean, not just for the insights, but just sheer time and effort that you have put in to share your thoughts with us. I mean, pension systems, we know, have endured a lot of challenges, and COVID-19 was a challenge, and certainly there will be more challenges. But I think to just hear it all from the perspective of a seasoned veteran like you, it certainly helps us to understand and get a sense of like, how do we prepare for the future. Now, we do have a few questions for you, and I will sort of use my moderator's privilege to go first here. And my first question, and you touched on some of these issues already in your speech, which is that we are already witnessing high inflation, interest rates are rising. And then on the other side, I think there's a lot of professional investors are now predicting that the market returns from the equity markets will be significantly lower over the next decade or so. So, I mean, combining all of these factors together, it could put in a lot of stress on the pension systems. Particularly, I'm thinking about the DB plans. So my question is two-part. So the first is, if this sort of high inflation, high interest rate, and low returns period, it's there to stay, for, at least for some time. First is, how do you expect plan sponsors, private plan sponsors, to react? Can we expect more cash outs, plan freezes, or do plan sponsors have any other options to adjust? And the second part of the question is, what kind of measures should we expect from policymakers to make sure that the pension systems remain resilient?
Yeah, of course, it's a really good question, and we live in a period where inflation we haven't had it for the last 10 or 15 years. But as I've said, we need to think about pension systems long term, over decades. So yes, there will be a rough time coming up. In terms of defined benefit schemes, this is where I come back to the point that I think the funded arrangements of defined benefit schemes are really important. That you need to look at the funds that are there. You'll need to look at the liabilities going forward. Excuse me. And we need to measure that, and then I suggest that the actuaries who look after those schemes need to put out to their corporate sponsor some scenarios of what might happen. So you don't just have one number that go forward. You need to have, this is our best estimate. It could be there or it could be there, because nobody knows the future for sure. And I think, to come back to your second part of the question, is that some corporate sponsors will say enough is enough, and we will wind back our defined benefit commitment. Whether we'll get out of it altogether or whether we'll get out of it for new employees, that will vary, I think, between corporate sponsors. I think from a regulator's point of view, clearly this is it's not really a new risk, it's the risk again. We've seen high inflation in the 70s and 80s, so there won't be many regulators who were still around as a regulator back then. But I would expect that the regulators will clearly pay more attention to the funded status of pension schemes. And they will say, okay, are you going to put more money in, or are you going to close it off if it comes to that? And now there are some pension schemes at the moment who are well positioned because they've had good returns in recent years. There are some that are closer to the line, obviously. And I think it will also depend, or will depend, on the attitude of the corporate sponsor as to how important pension schemes are in their whole package of benefits. We'll get to a situation where I think some corporate sponsors are saying, we're very happy to have an accumulation or defined contribution plan. We know what the costs are. They're 5, 10% of salary. We'll pay those. That's a fixed cost. Clearly, we're passing the risks on individual, but so I think that's. I think there'll be a range of responses. There's not a total single answer.
Okay, thanks. So the next one is, so you mentioned about the stress tests. So in your opinion, which system does sort of the best job in terms of stress testing the pension system? And in your view, how can this be encouraged in other pension schemes?
I'm not sure I've got a good answer to your question as to which system has the best stress testing, because I think when we're doing a little bit of work on this in Australia at the moment, what our regulator is called contingency planning, which is a fancy name for stress testing. But the point is that banks and insurers with their guaranteed benefits have done a lot of stress testing over recent years because they've had to. The regulators have said, do it. The pension system grew up, even with defined benefit systems, with a corporate sponsor standing behind it. And the corporate sponsor was almost insuring it, although legally they weren't. In most cases, they could walk away from it, but they were standing behind it to provide the benefits. I think we're just beginning to learn what a stress test looks like for a pension scheme. And it's not quite as clear as what it looks like for an insurance company or a bank, because a bank knows its liabilities. It knows it has to pay the deposits if someone turns up and wants the money out. An insurance company knows they have to pay you if your house burns down or you have a car accident. What's the risk in terms of pension systems? Now, in the defined benefit area, there are clearly some risks of funding. But in the defined contribution area, it's a little less clear what the risk is. And I think the biggest risk is operational, that there's a stuff up, if you like. There's a mistake or mistakes are made. And then there is a loss of confidence and trust in the system. And that's why I think it's really important that the operators, the administrators, the providers really take lessons almost from each other and from their near misses. How can we reduce the probability or the possibility of an error? And therefore, we want to encourage confidence and long-term trust. But I think there is work to be done in this space globally. I don't think any system's really done as much work as I'd like to see.
Okay, and I'll throw in one last one for you. So you mentioned also, you talked about, the interaction between the private system and the public system, that they need to really work together and be complements to each other. Now, in your experience, what you have seen, are there any systems, any model systems that are doing it well, or better, at least better than other systems, and so that other countries or other systems can try to sort of emulate that?
Yeah, I think this is the big question as to how you do that with aging populations and so forth. In my view, there's the ideal system would have almost multi-pillars, and let me explain a little bit. I think the concept of a universal pension paid to everybody gives you a base. Now, it might be 15, 20% of the average wage, but at least that gives a base to everybody. Above that, I would like to see, let's say, another 15%. It may be a social security arrangement, or it may be a means-tested supplement, so that those who need it get it, but those who don't need it, because they've got funds in social security or in a private pension system, don't get it. So I think you've got a combination of a base pension, a means-tested supplement, and then some funded arrangement, which could either be public or private or a combination of both. I deliberately say funded because I think the pay-as-you-go social security system runs out at some point. With an aging population, that's not the best system. So I do think what we're trying to do here is smooth an individual's or household's consumption over their lifetime. They might work for 30, 40, 50 years. You have to move some of those dollars into another pot when they're retired. But I think the reason I do like a bit of a base pension for everybody, it's twofold. One, it gives everyone a known base, and ideally you get political support from all major parties for that, so it's not a political football. The other problem is that if the whole public pension is means tested, which is what happens in Australia, where about 28% of the average wage, I will never get a cent. I have sufficient assets unless I blow them on the casino, not to get, and I'm an actuary, so I won't do that. I know the odds. But the problem with a fully means tested system is there are all sorts of adverse consequences because everything is means tested, and it's not just at the lower end, but it reaches into the middle class zone where means testing then causes older people not to want to get some part-time work when they could. That has labour market implications. It has a range of other implications. So I think there are consequences of it all being means tested.
Okay. Thank you. Again, it is a pleasure to bask into the knowledge that you have and that you are sharing with us. I know that we are sort of in a virtual setting, and it sounds odd to ask for people to give you a virtual round of applause, but if I could, I would do that. And I really, really thank you for you with being us today. Thank you.